Hey everyone! Welcome back to Novice Investing Guide, where we break down the world of investing in simple, bite-sized chunks. Whether you're brand new to investing or looking to fine-tune your strategy, today's video is for you. We're diving into two popular investment strategies, dividend investing and growth investing. By the end, you'll know the pros and cons of each and which strategy might suit your goals best. Now we are really getting into some real investment strategies that can help you get closer to your goal of financial freedom. These videos should be more exciting when we can really put strategies into practice and start to watch our wealth grow.
Let's start with dividend investing. Dividend investing involves buying stocks from companies that regularly share a portion of their profits with investors in the form of dividends. For example, if you own shares of a company like Coca-Cola, you could receive regular payouts just for holding the stock.
There are some terms that we need to understand to be effective at dividend investing. Dividend yield. It measures the annual return, in percentage, an investor earns from dividends relative to the stock's price. A higher yield can indicate good income potential, but may also signal risk if the yield is unusually high. Ex-dividend date is the first day a stock trades without the right to receive the next dividend. If you buy the stock on or after this date, you won't get the next dividend payment. The stock price is also adjusted lower by the dividend amount. Record date is the cutoff date set by the company to determine which shareholders are eligible to receive the declared dividend. Shareholders must own the stock by this date to qualify. Dividend payout ratio shows the percentage of a company's earnings paid out as dividends. A lower ratio can indicate more room for future growth, while a very high ratio might signal sustainability issues. Dividend growth rate is the annualized percentage increase in dividends over time. Dividend growth investors prefer companies with a track record of increasing dividends regularly, as it reflects financial health and management confidence. Blue-chip stocks are shares of large, reputable companies with a history of stable earnings and consistent dividend payments, such as Johnson & Johnson or Procter & Gamble. These are often favored by dividend investors. REITs, or real estate investment trusts, are companies that own or finance income-producing real estate. They are legally required to distribute at least 90% of taxable income as dividends, making them popular for income-focused investors. Dividend aristocrats are a select group of companies in the S&P 500 that have increased their dividends annually for at least 25 consecutive years. These are considered reliable dividend payers. Total return. This metric shows the overall return from both capital gains and dividends, highlighting the importance of reinvesting dividends for long-term wealth accumulation. DRIP, or Dividend Reinvestment Plan, is a program that allows shareholders to automatically reinvest dividends to purchase additional shares, often with no fees. This helps compound returns over time. Yield on cost is the dividend yield based on the original investment price rather than the current market price. Over time, as dividends increase, yield on cost can highlight the growing income from an older investment. Cash flow. Stability refers to a company's ability to maintain consistent or growing cash flows, ensuring it can continue paying dividends without interruptions. Payout frequency is the interval at which dividends are distributed, typically quarterly, semi-annually, or annually. Some stocks and funds, like REITs, may pay dividends monthly. Special dividend is a one-time dividend paid outside the regular payout schedule, often due to an exceptional profit or surplus cash. Wow, that was like a mental workout. Let's breathe deep for a few seconds.
Here are the key benefits of dividend investing. Regular income. You get paid regularly, even if the stock price doesn't go up. Less volatility. Dividend stocks tend to be less risky compared to growth stocks. Compound growth. You can reinvest dividends to buy more shares, creating a snowball effect over time.
But dividend investing isn't without its downsides. Slower growth. Dividend-paying companies usually aren't growing as fast as younger, high-growth companies. Taxable income. In many countries, dividends are taxed, which can eat into your returns. In the United States, we have what are called qualified dividends, which are taxed at the lower capital gains tax rate rather than the income tax rate. There are a few criteria to determine if a dividend is qualified. 1. The dividend must be paid by a US corporation or a qualified foreign corporation, those with a tax treaty with the US or traded on US exchanges. 2. The stock must be held for more than 60 days during the 121-day period that starts 60 days before the ex-dividend date. For preferred stocks, the holding period is 90 days within a 181-day window. 3. Only ordinary dividends from stocks are eligible. REIT and MLP, Master Limited Partnership, dividends are typically not qualified unless specified otherwise.
Now let's talk about growth investing. This strategy focuses on companies that are reinvesting their profits into expanding the business instead of paying dividends. Think of companies like Palantir or Tesla. Their stock prices skyrocket when they experience high growth. Growth investors aim for long-term gains as the value of these companies increases over time. But there are some important pros and cons here too.
Let's look at the benefits of growth investing. Higher returns. If you pick the right company, the stock price can skyrocket. Long-term growth. Growth companies tend to be on the cutting edge of innovation, meaning there's more potential for massive gains. But, like with any investment strategy, growth investing comes with its risks. More volatility. Growth stocks can be very risky, especially in times of economic uncertainty. No immediate income. You won't receive dividends, so you're relying purely on the stock price going up for your gains.
Now, how do you choose between the two strategies? It all comes down to your financial goals and risk tolerance. Let's break it down. Dividend investing might be right for you if you want regular income, you prefer more stability and less risk, you're focused on building wealth slowly over time. Growth investing might be better if you're aiming for high long-term returns. You can tolerate more risk. You don't need immediate income and can let your investments grow for years.
Here's the thing. You don't have to choose just one. Many investors create a balanced portfolio that includes both dividend and growth stocks. This way, you can get the best of both worlds: stability and income from dividends, alongside potential high returns from growth stocks.
So there you have it, folks. Dividend investing gives you regular income and stability, while growth investing offers high returns but more risk. What's your strategy? Let me know in the comments below. If you found this video helpful, make sure to give it a thumbs up, subscribe, and hit that bell to stay up to date with more beginner-friendly investing content. Thanks for watching, and see you next time.